Hello, everyone. I'm Adrian from Audio Excellence. Hope you and yours are doing well during this critical time, and we certainly want to make sure that everybody's doing well. Today, we're continuing on the series of financial independence, how to build wealth during this difficult time, how to make sure that in the future you and your family will be better protected and can weather future storms, so to speak. Last week, I started this series with Ennio, my friend. Ennio is a certified financial planner in Canada. So keep in mind that everything that Ennio will be talking about will be specific to the Canadian market. It may or may not apply to where you are. So just keep in mind. And of course, if you have questions, please email them directly to Ennio. His information will be in the description box. Ennio, welcome. Thanks for joining me.
Thanks for having me, Adrian.
Okay, so last week we talked in general about wealth creation, planning, holistic wealth planning, and so on. And I thought this week let's get into more specifics. So again, somebody comes to you and says, how do I create a plan for healthy financial independence? In Canada, we have a variety of different vehicles for that person to do so. Do you want to start talking about that?
Sure. So the first thing that I would tell them is that we want to put about 6 months worth of your income aside into something that is non-volatile. And we're seeing now more than ever that even if you have good cash flow and you have a good job, that cash flow can dry up at any time. And if you do have that 6 months worth of income put aside, then your anxiety levels are a lot lower. So where should you put the money? It could be as simple as a savings account, a checking account. I'd always say if it's there, look at some type of money market fund that you can transfer back and forth to very easily. If for those who are a little bit more adventurous, maybe some type of bond fund, some type of bond index, because the volatility is not going to be really high. It's not going to fluctuate up and down a lot, but the money will be there when you need it. Or some people, they want to have their money working for them, and so they have some type of line of credit, either a personal line of credit or a line of credit against the house that they can access at any time. And that's the most important thing, because we all know it's very simple to invest. You buy low and you sell high. You don't want to be selling in today's market because you need the money. So it's always important to have that money put aside somehow that you can access it. So that's the first thing I would recommend to them. The next question I usually get is, or the next thing I'm asked is, I'd like to put money in an RSP. How do we start investing? And the RSP is probably the most popular way of investing in Canada in terms of where a registration, as we call it.
And why don't you describe what an RRSP is for especially new investors or young investors who are just starting out right now?
Sure. So an RSP is not an investment in itself. An RSP is a registration. So you can buy a mutual fund, you can buy a stock, and you can hold it in an RSP, you can hold it in a non-RSP or a tax-free savings account. It's the same investment. The difference is that when it's in an RSP, any growth that you have in that RSP is tax-free growth. So if you earn any income during that time, if it grows in value and you sell it, you don't have to pay any taxes on it. Until you actually turn 71 and you convert it to a registered retirement income fund and you start to pull out the money, then you're taxed on it like it's income. If you pull out the money sooner, you're still going to be taxed on it like it's income. So it's not necessarily a locked-in investment, but it's money that if you take it out early, you do have the benefit of tax-free growth, but if you do take it out early, you might be taxed. So an RSP, or you will be taxed, and an RSP is not for everyone. I would say that if you are the type of person who has a pension at work, well, you're going to be living off of that income and it's going to be fully taxed. Maybe you want your money in a more accessible vehicle. If you're the type of person who uses their money a lot because you like to find opportunities that are outside the market, something in real estate, whatever that might be, the RSP might not be the best vehicle for you. So when you do put money in an RSP, you will get what we call a tax refund, a temporary tax refund that you owe back later. And that's what incentivizes a lot of people to get into an RSP. But if you need access to that money, you kind of have to give up on that tax refund in order to have more access and control over your money. So that's the first thing that we'll talk about. The other investment vehicle we'll talk about is something like a tax-free savings account. This is a different type of a registration. In a tax-free savings account, you can put $6,000 this year if you're over the age of 18, and your limit might be up to $69,500, depending on your age. So you can fully fund that tax-free savings account with most types of investments, such as stocks, bonds, mutual funds, index funds, ETFs, etc. And the money grows tax-free. When you take it out, it's tax-free, and that's an excellent investment vehicle. The only problem with the TFSA is that you're limited in the amount that you can put in. And really, if you maximize your TFSA, it's likely not going to get you to where you want to go for the rest of your life. You're not going to have enough money put in there to retire off of. So the last place that you can put money in terms of an investment is what we call a non-registered investment. It doesn't have any limits like the RRSP, it doesn't have any limits like the TFSA, and it's essentially the third leg in your investment tripod in terms of registrations. So many clients have some RRSPs, TFSA, and then non-registered investments. And non-registered are not tax-free, but they're taxed better than the RRSP.
So let me ask you a question related to all of that. If a person has some extra money, is there a specific priority in terms of where they should put the money in first, assuming a person is not the kind of person that likes to be able to or wants to look for opportunities to, for example, as you say, buy investment real estate or go into a partnership with somebody else or start a new business. It's just a person who makes money, has a salary, and just happens to have some extra money. Would you have a strategy in terms of where they should put the money in first? Say RSP, then TFSA, then non-registered fund?
My personal strategy, what I like best is I like the TFSA first because earning money tax-free is always a good thing. So that's the first place I would put it in. Then I would put it into non-registered investments. I have clients that have RRSPs, but I don't really promote them that much because I like having control over the money. And I like to use the analogy that imagine you're a farmer, Adrian, okay? And I'm the Canada Revenue Agency, and I come knocking on your door, and it's the dead of winter. And soon you're getting ready to plant your crop for the coming year. And I say to you, Adrian, I'm going to give you the opportunity to choose how you're going to be taxed for the rest of your life. And you say, well, I find this very interesting. What are you going to do? So I said, well, I'm either going to tax you on the seed that you put into the ground, or I'm going to tax you on the crop that you pull from the ground. So you think about it and you go, well, if I have a handful of seeds, that might cost me $20, $30, $40, whatever that might be. And if I'm taxed 30% on that, that's not a lot of money. But the seeds that I have in my hand, that can generate hundreds of thousands of dollars worth of crops. So I would, myself, and the way what we discuss it with our clients is I like the idea of taxing upfront, so I know how much I'm going to keep. I have more control, and I'd rather give the government less now than a lot more later. Because when you have these registered plans, I'll say to somebody, well, how much do you have in RRSPs? And they say, well, I have 400,000. Well, really you don't, because about 180, 190,000 of that, maybe even more, actually belongs to the government. And the whole idea with the RSP is that, well, when I retire, then my income is going to be less. That's possible, but we actually don't know where taxes are going to be. I mean, look at the events that are going on today. We have some climate change going on. We have pandemics going on. And who's supporting us in this? The government. The money's got to come from someplace. And if it comes from someplace, it's going to come from taxation. So we don't know what our taxation is going to be like in the future. And I'm a very conservative guy. I'd rather get my taxes over with today and have more control over my money later on. Plus, if you look at the idea that I want to earn less in retirement, it's almost like, well, I'm planning to fail. No, I want to have a better life in retirement. I want to be able to do things. I want to be charitable. I want to be able to help my kids, my grandkids, whatever that might be. To us, that financial freedom is the ability to do whatever you want to do.
So if I understand what you're saying, either of these three vehicles do not limit what you can actually invest in. Is that correct? So in other words, whether you want to invest in an index fund, a mutual fund, actual stocks, bond, gold, you can do all of those in any of those three strategies, the difference is basically the tax efficiency.
Correct. Correct. So,
Okay.
so when you don't buy a TFSA is not a savings account. It's an investment account that you can hold an investment in and just tax it.
So to summarize, in your case, you would recommend TFSA first, and then a non-registered strategy, and then RRSP.
For the most part, I mean, it's some people an RSP might benefit them, and there might be a strategy to use an RSP, such as you're saving for a home, or there might be the tax refund today might help you. So it's very, very specific to the person. But in terms of a lot of the way my clients are structured, the RSP doesn't benefit them as much as the other investments do.
And again, this is one of the reasons why in the last video, you specifically said you should always consult your financial planner for your specific needs. Yeah.
Correct. Correct.
Okay. What's the next thing you'd like to talk about?
So it's funny because I read something the other day, and it said that when markets are going down, about 67% of people who are in the market feel anxious. When markets are going up, 75% of people who are not in the market are feeling anxious. So it's funny because the question I get a lot right now, because people are contacting us all the time and they want to invest. And it's like, you know what? I know now is a good time to invest, but I don't know how to do it. How do we do it? What's the right way of doing it? What's the right investment to get into? And I always get that question now. And I got that question when the markets were doing really, really well, because everybody feels that there's some magic bullet investment that's going to make them figure out how to become very successful. And there's no one magic bullet. There's no one great company that's going to get you to where you need to go. So I want to share a story with you. Before this whole thing happened, I was looking at Tesla, the stock, not as an investment, but I was curious about it because around mid-January, Tesla was selling at $500 a share. And then it had a jump within a few weeks to almost $1,000 a share. And now it's back down to about $500 a share. It had gone as low as $300 a share. And this is all within a very, very short window. And the funny thing is that I don't know whether or not Tesla is a good company in which to invest. I don't know if they're a good company. They're a very popular company, but there's a lot about the company that we don't know. However, when I looked at this, the amount of stock that was traded on a daily basis, about 40% of the company was actually bought and sold on a daily basis at one point. And what we saw is that it really had nothing to do with whether or not the company was good if you were making money as an investor. It had to do with your market timing. So what happened was they had some good news, and then the stock started to take off. And as the stock started to take off, something happened called the fear of missing out. So people are like, I got to get in it. I got to get in on it. I got to get in on it. And then somebody bought at $968. And I'm thinking the person who bought at $968, most likely it's because that person, they didn't want to miss out on the stock, right? They said, I got to get in on this. Then it started to drop. So as it's starting to drop, you bought it based on emotion. Now it's dropping and you're going to sell it based on emotion and you're going to lose money. So within these past few months, people made money on Tesla, people lost money on Tesla. And there were smart people on both sides of that transaction, and there were dumb people on both sides of that transaction. So it really had nothing to do with the stock itself. It had everything to do with people's emotions centered around it and what we call market timing. So one of the things I tell clients is that we don't want to market time. Is now a good time to invest? Yes. Is yesterday a good time to invest? Yes. And I would even suggest to you that before the market crashed, it was also a good time to invest. Because we don't believe in short-term investing. Evidence has shown that the way you invest is by being in the market, not by timing the market. It's time in the market. So this is not just us saying this. You know, I would challenge your audience to look up a company called Dalbar, D-A-L-B-A-R, and they're just a research firm. And they do an independent study every year. And they go back 20 years worth and look back at 20 years worth of data. And they say, how did the S&P 500, which is the top index in the US probably, which is of the top 500 companies, how did that perform over the past 20 years? And then how did the average equity mutual fund investor perform? And for the most part, the numbers fluctuate a little bit. But what we find is that the average investor does about 4.5%, while the S&P does about 8%. So when the average investor is always trying to time the market, or they're invested in vehicles that are trying to time the market. So they are invested in what is known as an actively managed mutual fund. And in an actively managed mutual fund, what happens is that the mutual fund manager is trying to get a return for their clients. And what they're doing is that under the mandate of that mutual fund, for example, it's the Canadian Large Cap Fund, they're invested in large Canadian companies. And they might own Bell Canada and decide that they want to sell some Bell Canada and buy Rogers instead, because they believe that Bell Canada is overvalued and Rogers is undervalued, as an example. And so there's all this guesswork that's trying to happen. And amongst this guesswork, there's a lot of transactions, it's costly, and you have to guess right a lot. So when you compare that to just what the index does, the index traditionally outperforms an actively managed mutual fund. And so what I'll tell clients is that what we want to do is we want to really create a good index or ETF, exchange traded fund portfolio. And I'll use index and ETFs interchangeably because there's some differences, but in terms of how they perform, that's the main thing. So indices, ETFs will outperform traditional mutual funds for the most part. Then the other question is, well, so now I buy an index fund. There's a whole bunch of index funds out there. What do I buy? So first you want an investment vehicle that doesn't market time, like an index or an ETF. Now you got to choose what we call, Adrian, an asset allocation. So how do I get the right combination of all of these funds together that'll make me figure out, how I get a good return? Because people are looking at that asset allocation and saying, how do I get a return? How do I make sure I don't leave any money on the table? So I'm going to share a chart with you, and it shows the developed markets in terms of where they performed in the past 20 years. So Adrian, in 1999, would it surprise you if I told you that Finland was the top performing developed market in the world? Is that 138%? Now,
what was that again?
But 138%.
Wow.
That year, yes. So did you have a cell phone in 1998?
Yes.
You did. Was it by chance a Nokia?
Probably, yes.
Yeah. So in 1999, Nokia accounted for a good percentage of the Finnish market, and it had an incredible year, and it helped Finland become the top performing company. So every time I do this exercise with people, I tell them, well, what would you buy the next year? And they go, I'd probably buy Finland again. And then Finland dropped to the mid-pack, and then by the third year, it was at the bottom. And then, of course, it went up again. So internationally, we don't know which market is going to do well. So what's very important that what we do is we look at a global portfolio of these index funds. So, you start off with not market timing. You don't want to market time. Then you go into something like an index fund to keep costs low. Well, which is the right index fund? Which is the right ETF to go into? Then you look at something like a globally diversified portfolio. But the question is, how do I get the right mix? Because I have Canada, I have the US, I have other international countries, I have European and Asian countries. I also have developing markets, and I have emerging markets, and there's some good returns to be had there. So how do we structure that together? And then that's the thing that you have to sit down with your financial advisor and figure out what's the best way to do that.
Okay. You had mentioned to me in an email about an example of time in the market versus timing the market, and you said there were twins. Do you want to talk about that example, and then I'll get you to summarize at the end?
Sure. So let's take a couple of twin brothers. Let's call them Jay and Philip as an example. Okay. So Jay decides that he is going to put aside $500.
Wait a minute. Wait a minute. Which one's the dumb one? Because I'm going to have to tell them.
We're going to find out over here.
Okay.
So we'll see which one has the thicker skin. So let's start off with Jay. At the age of 20, Jay starts to put aside about $500 a month into an investment. And let's say he does this for 20 years. And he's going to have, let's say he gets a rate of return of 8% a year. Okay. At that point, Jay stops investing, but then he still holds on to the investment. And then at the age of 65, he's going to have about $2.5 million. So he just invested $500 a month, so $6,000 a year. So 6 times 12, $120,000 from the age of 20 to the age of 40. Then he stopped investing, but he let his money compound and grow. Now you're not going to have 8% a year guaranteed, so this is just kind of an average. He's going to have about $2.5 million. Philip, on the other hand, says, no, I'm going to delay, I'm going to delay, I'm going to delay. At the age of 40, when his brother stops investing, he's going to start. So he starts to put aside this $500 a month from the age of 40 until the age of 65. And he invests more. He invests $150,000. But what he has to show for it is $450,000. So he's invested more and he has a lot less. And it's not how much you invest, but it's when you invest, because compounding takes hold. And Albert Einstein said that compounding is the 8th wonder of the world. This is from Einstein, right? And it's what's made Buffett a billionaire. It's what's made a lot of billionaires or investors very successful. It's compounding. A lot of people think it's the market timing, it's picking the right investment. Absolutely not. The majority of people are going to be successful because they're putting money into the market, they're leaving it there, and they're putting it in early, and they're putting it in often.
Okay. So just before this gets too long, let's summarize. Your strategy or your recommendations as a general situation is, if it was you, again, let's use you as the example because you're the guy. If it was you and you had money, you would first put it into a TFSA,
right?
Then you would put in a non-registered vehicle, and then finally put it into an RRSP.
Yes.
Right. Number 2, buy index funds as opposed to actively manage mutual funds or even independent stocks in your opinion.
Yes.
Right. For risk mitigation and for also the lowest fees in general.
Right. Yes.
Okay. Now, this is something we didn't discuss, but I'm gonna ask you because I think it's important. Again, if it was you, leave our viewers with 2 or 3 index funds that they could research and consider for themselves. And of course, for specifics, they should get in touch with their financial planner or get in touch with you. But which are maybe 2 or 3 index funds that you could say to them, as you would say to your clients, have a look at these?
Well, there's a fantastic company out there known as Dimensional Fund Advisors. And that would be an interesting company to research in terms of how they manage their index funds. It's a little bit different. Then, Vanguard is always a very good company.
Before we go there, what do they invest in? Is it S&P 500s? What kind of an index fund is it?
Well, a company like Dimensional, they actually start off with a traditional index, and then they kind of modify it a little bit. So it's all the companies in the S&P 500. If you have a global portfolio with Dimensional Fund Advisors, you're actually invested in about 10,000 different companies. So you are completely diversified. In order for you to actually duplicate that, you'd have to have billions in personal wealth in order to duplicate that. What I always say is this: the U.S. represents about 54% of the investable assets in the world. Canada represents 3%. Countries like Japan are about 8%. Surprisingly, China is very low. It's only about 3%, even though their economy is very large. But that's because those are not investable assets that are available to the regular investor. The UK is at about 5%. Germany is at about 5%, etc. So always having Canada and the U.S. as a kind of foundation in your portfolio is a very good idea. So if you look at a U.S. Index from Vanguard, from BlackRock, from BMO, they're always kind of very similar because they invest in the same things. So I would leave people with this. That start off with Canada and the U.S. as a good part of your portfolio. Figure out how much risk you're willing to take, and have a bond component in there if you need to. Maybe 20%, 40% bond index, because the bond index will help you during these times and will allow you to rebalance, which is very, very important. And then you can see what you want internationally, but one thing I wouldn't do is if you had a really good performance from a small country. So, for example, Egypt and Brazil were very good performers last year. I wouldn't put my money all in Egypt and all in Brazil. I would have them as a small part of my portfolio, or any other company or any other country. The only thing is that don't go based on last year, because if you go based on last year, you're always investing by looking in the rearview mirror. And if you drive by looking in the rearview mirror, you're going to get in trouble. So you have to find a way to kind of capture those developing markets in an ETF. You have to find a way to capture the emerging markets in an ETF. But also, it's like when you go to Vegas. You don't go there with your life savings. You go there with a couple of bucks that you want to kind of see if you can win some money. But ultimately, the foundation of your portfolio should be developed markets.
So again, I'm going to ask you, I want specifics. We have to leave our viewers with specifics, even if they don't necessarily think that they need a strategic planner, but they're looking for some guidance from help. If a client was sitting in front of you right now and said, okay, give me one or two funds that you would recommend. If your cousin said to you, okay, I don't care about planning, and so I just want to buy two funds. Which are the two funds that you would say, okay, you know what, look at these two? Understanding that you're not responsible, that
I will tell you what I own. I will tell you.
Okay,
Okay, so
good.
let's go with that. I have a globally diversified portfolio.
Which one is that?
So my portfolio is done with a company known as Dimensional Fund Advisors. We can get into how they do their investments another time, because it's a bit more complicated.
Yeah.
But essentially, with my portfolio, if you look at the equity side, a third is in Canada, a third is in the US, and a third is in international and emerging markets. And then there's a small bond component to it, about 20% bond component to it. And what that allows me to do is it allows me to rebalance my portfolio during these times. So as equities are going down, I can take from my bond and I can buy more equities. So that's how I'm globally diversified. I'm in Canada, I'm in the US, I have international and emerging, and I have some bonds. And essentially,
so that's four separate funds. Is that what you mean?
well, it's actually a combination of 12 different funds, because I'm in Canada a few different ways. I'm in the US a few different ways. I have a little bit more small cap in certain areas because I want to take that risk. But the most important thing for me to know is that I have 10,000 different companies essentially that are working for me when I put my head on my pillow at night, and I have that type of diversification. So I'm never concerned about one market in specific or one company specifically in what that's doing.
Okay. So thank you very much, Ennio. I appreciate it. Everybody, if you find this useful and you have questions, please email Ennio. He'll do his best to help you. Again, it's always important that if you have your own financial planner, to get in touch with the financial planner and ask them for answers for your specific situation. And of course, you can always reach out to Ennio, and he will, if he can help you, he will do so. He has online webinars, and he can certainly speak to you online these days. Yes, Ennio, go ahead.
I have an offer for your audience. If they want to know more about investing, there's this great book written by Peter Mallouk called The 5 Mistakes Every Investor Makes and How to Avoid Them. It's not very thick, and it's a good read. Peter's a very humorous guy. And for the first 10 people who email me saying that they want a copy, I will give them a complimentary copy of this book. And it has some excellent foundations in terms of how to invest properly.
Is that PDF, or are you going to actually ship them the book?
It was a hard copy book. I'll lysol it before I send it over.
That's great. Hey, listen, thank you very much for doing that, and I appreciate the time. Everybody, this is Adrian from Audio Excellence signing off. Keep safe and take care of yourself. We'll see you again next time. Bye bye.